For those that haven't met, I'm Adam Aspis, managing partner at JAM FINTOP, and we're pleased to have Delphi present to the network today. Just for a background, I thought it was interesting. A couple of years ago, we were introduced to Delphi from someone on the sell side, and anyone who's experienced working with the sell side around asset liability management knows it's a very painful process that banks are having to upload a tremendous amount of documents. The young analysts at the sell side shops crank those numbers out over a period of days or weeks, and then send that information back to the banks. And usually that information can be somewhat stale by the time they're actually looking about what to do. And there's got to be a better way. We met the team at Delphi post Silicon Valley, and so asset liability management was sort of top of mind. There's probably not a better example of a failure around asset liability management more than Silicon Valley. So it's an area of focus for us, and we're really interested on what they're doing and using AI to take asset liability management to the next level. So with that, let me turn it over to Daniel and Joseph. Take it away.
Thank you very much, Adam and Matt and the entire JAM FinTop team for hosting us, and thank you all for coming today. We would like to share our Delfi Overwatch platform. It is a SaaS platform that's dedicated toward making asset liability and risk management on your balance sheet as simple and yet as controllable as possible. You think of our platform like you would an expert consultant, but in your pocket. It doesn't sleep. It always responds to your requests 24/7. But with full detailed analytical reports and impact assessments in minutes. And the platform also offers the ability to generate custom financial strategies and build your desired risk exposure with the assistance of AI. So today, speaking with us is our good friend and client, Don Quintana. He is the Vice President and Director of Financial Strategy and Analysis at Gulf Coast Bank and Trust. And together, we will be going through an example of a use case that reflects real-life scenarios that Gulf Coast and I'm sure other banks in the audience have faced, and how Delphi's platform helped address it. As I share my screen and walk through the example, the details have all been anonymized, but we combine details from our experience to create this case study that hopefully will reflect the thought process of real life problems that you guys are facing every day, and again how Delphi can fold into the process in aid of this. So our agenda today will be as follows. Don will kind of lay out the general problem, then we'll show you on the app how we were able to explore various strategies and solutions, and how Delphi was used to generate more powerful insights, and most importantly, run various what-if scenarios that allowed Don to stress test various possible responses to his problem. Hopefully we'll keep this all within 30 minutes and leave some time at the end for questions and questions and answers. So let's turn to the problem itself. Don, would you like to take it away?
Yeah, great to be with you all this afternoon. And I think Adam's remarks resonate well with me. I've been in banking probably 18, 19 years now. And the painfulness sometimes of compiling all this IRR information and other things. And so the Delphi solution that we'll talk about really has been something that we've enjoyed kind of working with them and getting to a better feel for. So just by a real quick intro, for those not familiar with Gulf Coast Bank, we're about a $3.4 billion bank. We're the largest bank headquartered in the New Orleans area. And if you were to kind of look at our balance sheet, we kind of enjoy typical good core deposit base relationships from what we've been able to build over the years. So from a cost perspective on our deposits, we're 2.5% cost of funds. So kind of in line with peer banks our sizes. We have some specialty lending divisions and some other things that are very high yielding for the bank. So if you were to look at us on the loan yield side, you'd see loan yields more in the 10 to 11% range. So kind of more of a best in class on the loan yield side. You put those two things together, we have a really good earnings engine for the bank. But I think as our bank has grown over time, it's allowed us to maybe be not have to be as heavily reliant on analytics and other things to make decisions, because again, the strong asset earnings kind of covers up maybe some of the marginal gives that we have on the balance sheet. And that kind of led us to one of the things we recently engaged with Delphi on. So if you looked at our deposit balance sheet, we had about a third of our CDs are kind of currently in time deposits. And we probably followed a similar path of a lot of banks, where back in 2019, we were about a third CDs. We saw that drop to below 10% through those early COVID years. And then we've seen CDs continue to grow over the last few years to back to be about a third or so of our deposit base. At the same time, we went from obviously having a lot of liquidity to deploy to being in a little bit more of a competitive rate environment. And so as like many banks, we started to take approach of keeping a lot of those CDs on shorter durations, laddering customers and other things with the anticipation that rates would start to move down. And as we got into the end of 2024, heading into 2025, we were seeing probably about 2/3 of those CDs that are on our books were going to be coming due over the next few months. And so we were faced with a lot of decisions of how to best to think through funding strategies and how we may want to deploy that to really maximize earnings. And so as we were having those discussions, we kind of were focused on three areas. First, obviously, we wanted to ensure we didn't have any liquidity shortfalls. As is already mentioned, SVB was not that far behind us. And so we obviously were very mindful of protecting and defending deposits where we could. Secondly, we obviously wanted to see where was the best choice available to us from kind of a static rate environment. But probably most importantly, and where Delphi really came in to be a value add for us, is we're faced with this very interesting rate environment. We're not really sure rates going to go up or down or where they're going to be. And so having them as a partner to start to think through that dynamic kind of rate environment and where we could make a best decision, not just to kind of maximize earnings, but reduce volatility of earnings over different kind of rate scenarios, is where that partnership, I think, really started to take off. So hopefully that gives a little bit of a picture of us as a bank and kind of where we were laying the groundwork for what Daniel will walk you through now.
Yeah, thanks very much, Don, for laying out the general context. So we'd love to kind of dive right into the app and show how the platform will be adding value to Don and his colleagues as they navigate this funding issue. So I hope everyone can see my screen. Again, we've just put up some anonymized balance sheet data, but you can see here about 2.8 billion in total assets, about 2.35 billion in liabilities, and while on the asset side, it's a kind of mixture of loans and securities. But on the asset side, it's a mixture of loans and securities. But on the liability side, you see a significant portion in the form of CDs, and that therein lies the heart of Don's dilemma. We can dive into the data itself, but basically, of the 2.35 billion in liabilities, we put about 800 million in CDs, and of those CDs, about 2/3 of them are scheduled to mature by the end of June. So they're facing a significant liquidity shortfall. If you leave this unattended, we'll kind of show you where what the actual impact results are. Let's kind of scroll down here and look at total cash. And so in the static rates environment, you can see here that their cash position becomes negative. It more than exhausts their current cash reserves of around 61 million. So the challenge is, what are the various funding strategies to make up for this pending shortfall in their funding? And we'll kind of go through these as potential different what-if strategies. So let's move over to here, and we'll go through each of these potential funding strategies in turn. let me turn it back to Don to provide more context on these different strategies.
Yeah, so I mean, as Daniel's pulling up a few different strategies we had took, and again, this goes back to the desire, really. I've got past history working at larger banks. I know kind of the analytic that can be laid down into making deposit decisions. And so again, that was the goal for this. And as I think about the discussions that were happening in our ALCO, a lot of times right now we're just relying on some rate shops, thinking about some historical performance and trying to, come up with more of the art of how we set rates or how we propose a strategy versus a scientific approach. And so, we're having dialogue in ALCO around, how much can we grow or retain deposits with a good CD promotion that gives us some core deposits that we might be able to cross-sell, deepen relationships over time? Do we rely on something like wholesale funding, tapping into our FHLB borrowing line because, that may provide a little bit better, cheaper costs of funds? Or do we start to think about, do we want to lock these deposits up into some type of CD that we kind of kick this can of a maturity bucket down the road again? Or do we want to try to migrate some of these into more of a money market account that gives us some flexibility potentially to navigate those rates, especially if rates were to start to decline over the next 6 months to a year? So those are some of the decisions we were, again, faced with. And in a normal ALCO discussion, there's definitely a little bit of science again there, but it's probably a little bit more of a gut feel. And so that's where, we leveraged Delphi to help us start to think through this and where the best choice selection may land for us.
Yeah, thanks so much, Don. So yeah, that's gives great context for all these different what ifs. We're very happy to show you how the platform can handle any one of the potential strategies that Don and his colleagues on the ALCO committee can be put on the platform with aplomb. So let's, for example, just dive into this one. For example, again, the challenge is that there's about $530 million of liquidity in CDs that are about to roll off and mature on the balance sheet. So what happens if newish CDs were issued at a fairly low interest rate of 4% and with 25% attrition on that 530 million? All of this can be added very easily in our what if strategies. We kind of show here. Here's a low rate CD with a fixed rate at 4% that expires in 2027. And let's say again that the amount of deposits that was able to be attracted was just 400 million. You can very easily add that into the platform and then run a what if strategy and kind of see what the impact is. So let's actually check first whether this actually, solved the actual problem of meeting the liquidity shortfall. So let's go back to total cash again. You can see here that unlike the negative sort of cash shortfall that we were in, now that this thing remains positive and the funding gap is met. So all three actually of these potential CD strategies, at 4%, at 4.25%, or 4.5%, all of them will check the box in terms of addressing the potential liquidity shortfall. But as with any sort of key strategic decision, there are trade-offs here, right? We need to think through the impact upon earnings and the impact upon sensitivity from these strategies. So let's take a look, for example, at, again, this lower interest rate CD and see what happens to cumulative net interest income here. You can see here, I'm showing you the absolute values. We can look at it from, let's say, margin terms. And in the static rates environment here, you can see that the impact of this funding strategy will cause the net interest margin of the bank at the 12-month mark to fall from 11.09% to 10.61%. So that's a 47 basis point drop in the net interest margin at the 12-month mark. Obviously, we can look at this across different sort of horizons, but that kind of shows you the trade-off of trying to recapture these depositors at this significantly higher interest rate. And that trade-off will get even worse as we move into considering different strategies. So in this case, the margin compression in the static rate scenario is 56 basis points. In the very attractive 4.5% yielding CD, the compression is 66 basis points. So you can see how the different amounts of liquidity, you can sort of see the pros and cons of these different CD strategy approaches. Let's move on to the next sort of strategy that they were considering, which was borrowing from the Federal Home Loan Bank. What we put in here, going back to the description of what the Federal Home Loan Bank strategy is, they are borrowing from the Federal Home Loan Bank, and we just put in here 5-year term that is an amortizing loan, and we just looked up the latest numbers for a 5-year amortizing loan and put that in. And going back again to the strategy impact page and turning to the Federal Home Loan Bank strategy, you can see here that again in the static rate scenario, margins are getting compressed, but from 11.09 to 10.56. So going back to the examples earlier, this is about the same degree of margin compression as we saw in the first amount, the first CD strategy. So this one is 10.61. This one is 10.42. But we assumed that the amount of liquidity that they could attract here was 500 million. So this was providing the same liquidity boost as the higher rate CD strategy, but with the margin compression of the lower CD strategy. So seemingly the best of both worlds, but there's one final, I think, very potentially innovative funding strategy that Don mentioned in his comments, which was to introduce a promotional money market account with a minimum rate of 4.25% for just 90 days. And after that, it will be floating. So we put that into the balance sheet what if strategy as well. But for this one, not only is there going to be an impact upon just margins in general, but there's also going to be an impact upon the sensitivity of the bank's balance sheet to interest rates, right? All the other funding strategies considered, whether it's CDs or a fixed loan from the Federal Home Loan Bank, they're all on a fixed basis. But this funding strategy is on a floating basis. So we're going to expect an impact upon the overall sensitivity interest rates as well, and not just upon expected NIM. And we can see that here, where not only is the margin compression still there of down to 10.51, but actually, if you look closely, you can see that the sensitivity of the balance sheet to interest rate shocks, in these cases, these parallel rate shocks, are changing. And with Delphi's platform, Don could actually not just look at these classic parallel rate shocks, but look at the full sort of Monte Carlo simulation of all of what's going to happen to the balance sheet profitability in thousands of realistic interest rate scenarios according to what current market expectations are. So looking at this here, you can see that this gray distribution is the bell curve of the risk distribution of their cumulative net interest income without this funding strategy. And this is their cumulative net interest income bell curve with this particular promotional money market account strategy. And you can see here that the the golden distribution, the golden color distribution is significantly narrower than the gray colored distribution. A quick look at the statistics table shows that while the mean is falling from 280 million to 267 million, the standard deviation, so the sensitivity of the balance sheet to interest rate shocks is also falling by almost 35%. And so this is actually very good news. The fall in sensitivity is happening because the bank was already asset sensitive prior to this funding strategy, and introducing a variable rather than a fixed source of funding has the effect of counteracting the inherently asset sensitive nature of the balance sheet and becoming a natural hedge and insulating the bank from further interest rate shocks. So with this money market promotional strategy creating roughly the same amount of margin compression and the ability to generate the same amount of liquidity as the mid-rate CD strategy, but also creating a natural reduction in their sensitivity to interest rates amid this, currently very high uncertainty around the future direction of interest rates, as Don just mentioned, makes this promotional funding strategy a very compelling one, according to the platform. With that, love to turn it back to Don to kind of describe the benefits of using the platform in thinking through the implications of each of these strategies.
Yeah, I think you could hopefully get a sense from how Joseph's operating. Daniel's operating through the visuals. You're not only getting great analytic support here, right? You're getting a lot of visuals. I love this one as we've talked a lot about. Prior to joining Gulf Coast, I was at a much larger regional bank, a bank that was probably about 25 to 35 billion in size when I was there with them. And I kind of know the roadmap that our bank needs to continue to go on. Right now, we're in a position, right, where we're doing some of our ALCO in-house, but we're having to outsource a lot of it. We're crunching a lot of data, sending it off to an outside party who's returning that stuff. It's coming back a little bit stale for us by the time we finally get to it. And really the reports are all driven around static rate type of scenarios where you're seeing the impacts of 100 basis point jumps up or down and things like that. And that's helpful, right, to have discussions. But really, again, it goes back to understanding that the evolution of our bank. We really needed to get away from just the gut feel of things and really starting to drive decision making more with an analytical type of rigor. And this allowed us to really start evolving to be able to do that. Not only can you kind of get this information in here quickly, you could see through all these 5 different scenarios that Daniel walked us through that you're able to kind of put in a bunch of multiple scenarios very quickly, iterate upon those, and kind of digest the results to guide a decision. A lot of times right now for us, we would be in an ALCO meeting and you spend time, right, spinning up information to discuss. And then somebody in the meeting comes with, well, what if we did this? Or what about this? And we'd often be faced with that kind of problem of not being able to do something quickly on the fly, probably having to go back and either run some Excel scenarios, send that information back out to the group for discussion by email, or have a separate follow-up meeting if that was needed. Or, worst case, having to go back to our outsourced partner and have them run information for us, which even provides a further lag. So all those things just are a drag in the decision making. And if you think about how dynamic the rate environment's been for us, especially in the last year or so, time really can become money in that sense. Another thing I know that resonated with our group as well, if you think about, every bank's ALCO members are a little bit different, but we've got some very sophisticated folks who really get all of this type of stuff. And we have other folks who come at it from a little bit more of a sales perspective or other lenses, right? They may not be as analytically focused as somebody like in our finance division is. And so again, the visuals to me help convey a story, help some of this information kind of burn in more quickly. So not only are we able to kind of run some one-off iterations to support a more fruitful discussion kind of real time, but the visuals, again, I think help everybody understand really what you're looking at. And then kind of going back to some of these Monte Carlo scenarios that Daniel was pulling up. Another thing I know that we were starting to get more questions from our regulators on were, hey, well, what are you all doing? Like, yeah, we see y'all are doing the static rate scenario type of stuff, but how are you all thinking about economic projections? How are y'all thinking of steepener or flattener type of scenarios and other things like that? And so I really do like how this Delphi tool really kind of incorporates a lot of general market expectations in where we truly think right now the economy is kind of trending towards. Again, it's been a very interesting time, and so that ability to as the rate environment continues to shift around, to be able to come back to this and rerun a different scenario and see kind of how that shifts, again, I think really starts to aid the decision making. So, again, I think you could probably see just from this short kind of walk through, the tool's very powerful. It's pretty intuitive to go ahead and get the data in there and start to run it. Again, you can do this pretty quickly on the fly. So again, it can be done in meetings. So like the way I think of it is, for us as the size bank we are, and knowing kind of some of the tools that are available to larger banks from my past experience, I think this is something that allows a bank to start to punch above its weight in terms of being able to, again, have that kind of analytical rigor that a much larger bank would be able to have at their disposal. And so, again, I think without having that partnership with Delphi, again, we're relying on a little bit more of a gut intuition, and I think we likely are going to be leaving behind kind of valuable earnings. So I think they've been a great partner to help us think through this stuff, and we just really appreciate the opportunity we've had to work with them over the last year.
Thanks very much, Don, for those kind words and for all of your support and time today. So yeah, to everyone in the audience, we hope that this case study was interesting and it gives you a flavor of how the platform is really designed not just to be a check the box, ALM reporting sort of exercise here, but really a strategic decision engine, a decision tool that helps banks think, bank ALCOs, weigh various strategic options, weigh various funding strategies, weigh almost anything that may be, confronting an ALCO. It could be rebalancing of securities portfolios. It could be buying or selling loans on the secondary market. It could be entering into derivative-based hedging strategies. It could be M&A transactions. It could be new sources of loan origination. Like any and all of these things are effectively what-if strategies that can be put into this platform and run to generate impact assessments and a full kind of Camel's summary of that potential strategy in minutes. So it's really, again, designed to help, as Don said, help banks punch above their weight in terms of bringing some rigor to the ALCO decision-making process. Again, to the banks in the audience, we're happy to announce that there are currently 21 banks that are now on Delphi's platform, both the Essentials and the Overwatch platform, that now represents over $170 billion in total assets under technology. I should also mention that we have a completely no cost, no time limit version of the platform that we're calling Delphi Essentials, where you can generate a lot of these cutting edge balance sheet simulations and what if strategy impacts analytics at any time. So please go to our website to sign up if you're interested. And we are continuing to innovate on solutions for improved and intuitive interest rate risk management tools. We will shortly be announcing a new kind of product. It is a no hassle, inexpensive swap product, and we will be looking forward to sharing more details of that soon as well. But In the meantime, we want to again thank Don for his continued support and his generous time today discussing his some case studies. We want to thank Matt, Adam, and the JAM FinTop team for hosting us today. Thank you again, and looking forward to taking any questions.
Yeah, Daniel, I'll just interject real quick and just encourage all of the bankers on the line. Would love to hear from you. If you have any questions, please feel free to use the Q&A function at the bottom of your screen. I know that Adam and I had a couple of questions and follow-ups, and echoing your comments there, Daniel. Thanks a lot, Donald, for taking some time with us here this afternoon. Daniel, maybe just give us a sense of how much data you need to ingest to feed, these models. What's the lift for the FIs in terms of what they need to provide, and how is it being delivered to Delphi in terms of all the data necessary?
Yeah, it's a great question, Matt. We have seen banks get set up and going off to run within an afternoon, basically. It kind of depends basically upon how granular you would like to put in the data. But let me share my screen again. If we go back to the balance sheet page here, you'll see this ability to download an Excel template, and you can put in and populate all of the columns here with all of your balance sheet data to whatever level of granularity that you like. If you sign up for the Essentials account, we will always have pre-built for you a call report based balance sheet just to help you guys get started, to get people get started. But it's kind of in your control, the amount of granularity of the balance sheet data that you want to put in. But yeah, it can be if your balance sheet data is good, or if you just want to hook us up with your core provider, that can happen within just a couple of hours. Yeah, I don't know, Joseph, if you want to add anything to that, but yeah.
No, we have very little time, so would like to just continue answering any questions.
Maybe just talk about the AI. I know there will be a lot of questions about how the AI is being used and how do you trust it? How do you know it's not hallucinating? What's the best answer?
Yeah, another great question, Adam. So I want to make one thing very clear to everyone in the audience. Delphi does not use AI in the way a lot of other startups use AI. All of the balance sheet simulation logic that we just went through, that is not built on generative AI or large language models. We instead are using a kind of AI for optimization and for computational speed and accuracy. So normally the kind of detailed simulations done at the granular level you see, and it can take hours for even modern computers to run it. But we've optimized it in a way that allows these reports to be generated within seconds to minutes. I think the longest ever report, it took maybe 15 minutes to run. And that is allowing us, the clients, to be able to start using this decision tool in real time, kind of during the ALCO meetings, as kind of Don laid it out. Now that said, and Joseph can speak more about this as well, we are currently building an agentic layer over this as well to help people navigate the app even more efficiently. So we are going to use, we are building a generative AI layer to help people interact with the app more easily. But the underlying engine of the app itself is not using generative AI, so there's no risk of hallucination, period.
Okay, well, we're going to post this webinar on the JAM FinTop portal. So if the bankers have colleagues that missed the webinar today but want to watch it, that will get posted shortly. And Matt, anything else?
No, yeah, registration for our summit is live as well. And so these are topics that we'll continue to dig in, lots of content and kind of staying anchored in our key themes here that are outlined on the portal, and would love to hear your feedback. We're happy to connect you with Joseph and Daniel if you have any questions or want additional materials for your institution to learn more about Delphi. But yeah, thank you very much to all of the participants who joined us. Daniel, Joseph, Don, thanks for your time, and look forward to hearing from everybody. Have a great afternoon. Take care.
Thank you, everyone.